Welcome everyone. Thanks for joining us tonight. And if you've been on the previous Zoom sessions, you'll find this just works into the previous ones. There'll be some repeat and there'll be some new information as well. In addition to the reminder that Sam gave you in regards to the taping and these available on YouTube, have your cell phone ready, and if there's a screen that comes up that you want to capture, just take a picture of it and feel free to share it. And feel free, this is my contact information. I'm located here in Pincher Creek. I'm a certified financial planner, so I help a lot of people with retirement and budgeting, those sorts of things, as well as investments. But if you got questions, concerns, you can contact me at any of those numbers or the email, and that will appear at the end as well. This screen I'm not going to spend any time on. We do a lot of this to educate group benefit plans and when people are retiring and those sorts of things. So that's what that screen is about. So the key topics tonight is what your retirement looks like today. What does retirement mean to you? Because it means something different to everyone. We're going to look at some of the sources of income at retirement, and they're certainly not exclusive. There will be lots of others that you could have. And then the next step to protect your retirement savings and prepare your legacy. So again, feel free to drop questions in the chat box there anytime if I say something that doesn't sound right. So as of a survey of 2017, and I saw one just the other day that was dated, I believe, 19, that is already showing, it said that the average age for men now is through to 80 years, and for women through to 84. I saw one just 2 days ago that said that women were actually up at about 86 and men were at about 82. So it becomes very important, particularly if you're retiring early, to know those sorts of things, because if your life expectancy is 70 as opposed to 84 or 90, you need a whole lot less money. But if you're going to live a long, healthy life, I don't think anybody wants to run out of cash. There you are. That's what I said. So the reality is we're living a little longer. For women, it's actually up to 85.2 years, and for men just a little over 80. And those are growing quickly with the medical advances. Will be no time, where everyone will be up to 80. Interestingly enough, statistics also show that as a married couple, that the chances of one of you living beyond the age of 90 is something like 60%. So one of you is going to make it that far. So in days gone by, lots of people talked about retiring at 50 and 52 and 55. And one of the questions now, because there's a lot of folks that are around that 66, so will you be working at age 66? And you're going to find that there's a lot of surveys and a lot of statistics in some of these presentations. This is one of them, that 32% of working Canadians expect to be working full-time at age 66. 27 expect to be working part-time, and 27% expect to be retired at age 66. So, there's only really 27, almost 30% that expect to be retired. The other 70% either aren't sure or they're pretty sure they're going to be working, which again lends credence to why you need to plan for this. This is a slide that I normally have in some of the other presentations, but 38% of Canadians say personal finances are their biggest source of stress. And as I mentioned last week, in the times that we're living right now, I don't think it's an exaggeration at all to say that, that's probably closer to 100%, that everyone is stressed. We're not sure when this health crisis subsides. We're not sure in a lot of cases what our job prospects are like tomorrow or next week or next month. So people with health issues are more likely to have financial challenges, and stress levels also go through the roof. So it affects us all the more reason to hit it head on like you're doing here tonight. I may not have all the answers for you, and you may not be perfect with your retirement planning, but at least it gives you an idea, and perhaps you can can grab hold and start to make some changes. The reasons that folks would be working past age 65 is 59, 60% of them again feel they need to be working past, and 41 say they want to. And there's a lot of folks, we go back to the slide that talks about how healthy and how long people are living. Unless you've got some other opportunities to go and do things and keep yourself busy and feel useful, there's not a lot of folks that can golf full-time into retirement. For one thing, it becomes a job. For another, it's also not an inexpensive pastime or whatever you're doing. So lots of people are choosing to work. But what do you want in retirement? And those are the questions that you and your spouse, if you have one, need to discuss, because you need to be on the same page. And I've worked with enough retirement folks now that I've also seen where lots of them will stagger their retirements. If you really get along well and you share a lot of things, nothing wrong with retiring at the same time. But a lot of folks I've worked with, they will retire 6 months or a year apart to allow the one that's in retirement to start to find their groove before the next one enters. So what do you want to do? You want to dine out lots? You want to golf? You want to volunteer? You want to spend more time with family and friends or travel? Maybe you wanted to go back to school and take some educational courses or find another career. You want to entertain yourself, fitness, work, or possibly, and lots of folks do that, buy new properties and renovate and flip them, or just retire into them. But your lifestyle will change. And this is a graph that those of you that were with me last week will have seen, that as you age, your lifestyle expenses will very likely decrease, but your health needs will very likely increase. If you're one of the fortunate ones that doesn't happen to, that's great. But statistically, stuff just happens to our body, regardless of how well you've looked after yourself. Things do start to wear out. And so as a result, you'll have a few more doctor's appointments possibly and a few more meds. What this is showing is that, yes, there's basic living expenses and the protection needs pretty much stay level throughout, and it's the other factors that change. So how much pre-retirement income do you think you'll need? And that's the question that will stump everyone that comes to my office. So statistically, again, they suggest that you need 70% to maintain your lifestyle in retirement. So to put that into perspective, if you're making $100,000, for example, between the two of you or individually, by the time you pay taxes and you pay all the things that come off of your paycheck, you're probably down around that 70% mark anyway, is what your take home is. So this is just suggesting that you want to maintain your lifestyle right in there. 50% will allow you to live comfortably. You maybe won't be able to do some of the things that you did pre-retirement, but you may not want to do some of the things you did. You also won't have the same kind of expenses, quite possibly, that you had when you were working, clothing expenses and gas for the cars and meals and those sorts of things. And you may indeed need 100% or even more of pre-retirement income if you plan to travel. And I've certainly worked with clients like that who, for the first 2 or 3 years, they want 100 or 110%, because after that, they don't plan to go anywhere. So that's why you tuned in tonight. Where's the retirement money going to come from? So sources of income in retirement. You've got government programs, you've got your own savings, your registered retirement savings plans, which will turn into a registered retirement income fund. If you've had pension funds from a pension that you've transferred into your individual hands, that's turned into a locked-in retirement account, that will be changed to a life income fund, and then payout annuities and other savings. We're going to talk about each one of these in a little more detail as we go through. First, we're going to cover a couple of other items. So the very first thing is CPP and old age security. So if you've lived in Canada and for at least 10 years and you've worked and contributed into CPP, you will be eligible for a CPP benefit as early as age 60. Now, currently it's age 60. I believe there's talk again about extending it, but at this point you can take it as early as 60, and there is a reduction in the benefit of, I believe it's 6% per year that it reduces prior to age 65. The maximum benefit is available at age 65. OAS kicks in at age 65. You cannot get it before. And again, it's based on you have to be a Canadian citizen and how long you've lived here in this country. And then guaranteed income supplement, you have to be receiving the old age security package and have an income of less than 18,600 as a single or 24,576 as a couple. It's a low income benefit, and these are 2020 numbers. So they've been revised a little bit this year, but they're pretty close. So CPP, and for this sake, we won't talk about the Quebec pension plan rules because we're in Alberta, but CPP employees between the ages of 18 and 65, employers must deduct the CPP contribution. If you're an employee, if you're a contractor, then that's up to you to make those contributions. Employees between the ages of 65 and 70 can elect to continue to have CPP taken off, or they can elect to stop it. And employees age 70 or more, there is no CPP deduction. Okay. So there is an enhancement program that will be phased in starting last year and will complete in 2024. And what we will see is an increase in the contributions that are made by the employee and the employer. So phase 2 will start in 2024 and will introduce a second higher earnings limit. So it's a constantly moving target now. As a large percentage of the population starts to age, the government's looking for ways to maximize their dollars in their pension plan, and this is one of them. Or agree or disagree, it really doesn't matter. That's the way it's going to work. So as of 2020, your maximum benefit at age 65 for Canada Pension Plan would have been $1,175.83 a month. The average, though, the average benefit for a Canadian is $672.87. That's based on, again, as we talked in the previous screen, how much you've contributed over the years, how many years you've worked. If you've been fortunate enough to always been near the maximum amount of contribution levels, then you'll be close to the maximum benefit. But if you haven't, then, and you may fit into the average at $670. Old age security, similar story. At age 65, $613 available on a monthly basis, and the average payment that's coming out to an individual there is $572. Guaranteed income supplement, again, remembering you need to qualify on those income levels, and you need to be receiving old age security. The benefit for 2020, maximum benefit was $916, and the average benefit was $586. Okay. And there at the bottom of the screen, if you want more information, you can see that there is a website that you can access, or a 1-800 number that you're able to call as well. And again, if you miss some of these screens, you can go back and you can get them from the recorded version when it's posted in a few days. So how does the timing affect CPP? So remember I talked about the reduction earlier if you took your money early. So you get your proposed benefit at 100% at age 65. If you take it early at age 60, then you're realizing a reduction down to 64% of this benefit. So if it's $1,200, it's 64% of $1,200 is what you'll receive at age 60. It'll be a little higher if you start receiving at 61, 62, 63, 64. There's reasons why you may want to consider to take your CPP early, and those are things that you should discuss certainly with your family members, but also discuss with people like me or your accountant as to whether it's an advantage to you or whether it could burn you in the long run. If you wait and leave your CPP until age 70, then your benefit in relation to the age 65 benefit actually increases to 142% of the age 65 benefit. So in real numbers, age 65, $8,100 a year. If you take it at age 60, it reduces to $5,200 a year. If you wait and take it at age 70, it's $11,500 a year. And again, there's reasons why you may or may not want to wait, and you need to investigate those for yourself. So one of the things we first talked about was the Registered Retirement Income Fund. So a RRIF is just the exact opposite of an RRSP. The RSP you put money into, it's an accumulation vehicle. The RSP is it, or the RRIF is a deaccumulation vehicle. That's how you start to take your money out, and then you're taxed on it a portion every year. So taxable withdrawals according to your needs. So you can, with a RRIF, you have a minimum but no maximum. So if you chose to, you could take the whole amount out in the first couple of years. But at age 71, you have to elect to turn your RSP into a RRIF by the end of the year in which you turn age 71. And currently, the rate which you will have to start withdrawing that money will be 5.5% at age 71, going into age 72. If you start at 65, the percentage is less. Again, those are numbers that I can help you with, but we're not going to get into all that tonight. You can choose what it's invested in. So it could be in a guaranteed income certificate, a GIC. It could be in a mutual fund. It could be in whatever you want it to be. And as I said, the maximum annual withdrawal or the minimum annual withdrawal is required. Locked in funds, so life income funds. The only reason you would purchase one of these is if you had pension funds that you had transferred out of a pension at some point, and they have to go into a LIF, a locked in fund, or can be split, and there's mechanisms by which you can unlock some of that and move it to your RSP. We're not going to get into all those rules and procedures either tonight. If that's something that you want to investigate or discuss, I invite you to give me a call or fire me an email or go on the internet and Google it. You'll be able to, it's very clearly understood or explained there, but I'm happy to discuss that with you. So again, the investments are managed by the owner. Each year there is a minimum and a maximum withdrawal. So you cannot clean this out. It's designed to last for a certain period of your life. And you can also take this money and purchase a payout annuity. So both the RRIF, the Registered Retirement Income Fund, and the LIF, you manage. You're in charge of it. You choose the funds, whether they're GICs or market-based funds, and you live by however they perform. Now, a payout annuity is a series of payments in exchange for a lump sum. So the very best way to describe a payout annuity is it's your own Canada pension plan. You would take a lump sum of money, whether it's an RSP or a LIRA, which is the locked in money, or it can be non-registered money, and you can buy a payout annuity. So where you would use a product like this is if you wanted to guarantee your basic living expenses. So you're entering retirement, the markets are volatile or they're not. You just want to make sure that come the very worst circumstances that you're always going to have a roof over your head, food on the table, and heat in the house. If we determine what that number is, what that base number is, so we take your CPP and your OAS and we add them together and we look at your basic living expenses, and if there's a difference, that's one of the places you can plug a payout annuity in, because you'll purchase that contract. It'll guarantee to pay you X number of dollars a month, month in and month out for the rest of your life. So you don't have to worry about a nickel after that. You can also put a guarantee period on it so that the same amount will flow to your survivor. So if it's a couple, a married couple, and one of them passes away early and they've got a payout annuity, you can guarantee those payments through to age 90 for that survivor. So factors that affect the amount that you can purchase in an annuity is the life expectancy. If you purchase it at a younger age, it'll be a little less than what you can receive if you purchase it at an older age. The amount of capital that you use, interest rates, as well as mortality and morbidity rates, because these products are only purchased through life insurance companies. So if you go into your bank, they may or may not know about payout annuities. It's only a product that can be handled and administered through an insurance company. Okay. Types of annuities: there's individual payout annuities and there's joint and last survivor payout annuities. Again, you got some interest in them, give me a call. We can discuss it. We can go through the pros and cons and try to help you make an informed decision. So what do you choose? Well, it doesn't have to be one or the other. You may have all three. You may only have one. But if you've got RRSPs, you can certainly put them into a RRIF or a payout annuity. If you have locked in monies, you can put them into a LIF or a payout annuity. So the RRIF, less predictable, as is the LIF. The RRIF minimum, but no maximum, where the locked in money has a maximum. You can convert either the RRIF or the LIF to a payout annuity anytime, but once you purchase a payout annuity, you don't get back out of it. So it's a decision you want to make well informed and make sure that you do the right thing. Again, as we spoke before, investment choices in the LIF and the RRIF are flexible. You're responsible for it. Another form of retirement savings, which has really come into its own in the last couple of years because it's actually grown to a substantial amount now that you can contribute. The number at the very bottom right hand of this screen says $69,500 as of 2020. As of 2021, that amount has increased by $6,000. So if you've never contributed to a tax-free savings account, you can now contribute $75,500. You can put it in any number of different kind of investment vehicles. A lot of people are confused by the name because it's a tax-free savings account. It does not have to be a guaranteed interest rate savings account. It can be mutual funds, it can be individual stocks, it can be GICs, or it can be a combination of any of them. You can have as many tax-free savings accounts as you want, as long as you don't over contribute. And therein lies the problem. If you get more than one, sometimes you have trouble keeping track of where you've put your money last. You put money in both accounts, you end up over contributed. The government doesn't like that, and you pay a fairly hefty fine on a monthly basis for as long as you're over contributed. Anyone over the age of 18, so anyone turned 18 in 2009 is eligible. In 2009 and older. The money in that plan grows tax-free and it will come out tax-free. You do not get a deferral or a deduction for putting money into a tax-free savings account, though. It's tax-paid money you put in. So this slide shows the maximum contributions that were available through the time. If you haven't used them, it's cumulative, so you can use it at any time. If you don't use it this year, there's very likely there will be an increase again next year, and you can drop it in any time. So any adult child, anyone over the age of 18 can contribute to one of these. You do not have to have earned income to contribute to it like you have to with an RRSP. A TFSA is also used as a tax planning tool where maybe the higher income spouse will purchase money into a TFSA for the lower incomer earner. It then becomes their money and it comes out to them tax-free. Okay. We're going to talk a few minutes about considerations in retirement and how to protect your retirement. And I think we're okay for time. Yeah, we're just about 6:30. So we're going to try and wrap this up in about 40 or 45 minutes and give you time for questions. So make your money last. That's where we go back to the payout annuity. If you have trouble and you recognize you have trouble managing your money, a payout annuity may be an alternative for you. We need to be very cognizant of how we start to draw retirement income. For the second item there, income tax, because you want to make effective use of your dollars without paying it all out in tax. So sometimes when we're working with folks, if they've got huge incomes that they know are going to come in into their 70s, sometimes it makes sense to start drawing your RRSPs and turn them into a RRIF way before age 70 or 71. Sometimes at age 60, sometimes earlier. Working part-time versus full retirement, maybe that's an option for you. Maybe it's a necessity. Maybe it's just a choice that you want to have something to do. But whatever it is, you need to have ongoing retirement plan management. And it doesn't mean that you need to meet with somebody like me necessarily once a year, though that's probably a good idea if you have a financial planner, but you need to monitor where everything is going, particularly when the markets are volatile and they're up and down. The last thing I think anybody wants to do is run out of money. And then you got to manage leaving the balance of your money to loved ones. So it's not just a simple matter of, okay, I'm going to spend everything I can, and then whatever happens, happens. You can choose to do that, but quite often the beneficiary of those sorts of plans is Canada Revenue Agency. So if you take the time to ensure beneficiary designations are correct and you've taken all the appropriate measures, you can ensure that your loved ones receive the maximum benefit from your estate or your charity. So some of the things to help you protect your retirement cash is personal health insurance. So we talked about that earlier. As we age, our health sometimes goes sideways. The important thing to remember about health insurance is that if you wait until you've had an event where you require health insurance, such as prescription drugs or something along those lines, it's a very good possibility you're not going to get it. It's like the analogy of, you don't buy house insurance or fire insurance on your house, I'm sorry, but you wait until the fire starts and then you call your fire insurance agent to try and buy it. It doesn't work that way. So you need to plan to have your health insurance in place, whether it's a continuation of your group plans or whether it's something you purchase yourself. Critical illness insurance, it can be fairly costly as you get older and later in life, but it's payable for a specific or defined illnesses. So in Sun Life's case, there's 26 defined illnesses that it covers, and it's a lump sum tax-free cash benefit, which will allow you to use however you wish. So if, for example, you had a $100,000 critical illness policy, you suffered a heart attack, for example, that caused some heart damage, you would be eligible, very likely to collect on that critical illness. $100,000 check, tax-free, would be delivered to you, and then you spend it however you want, whether that's treatment or whether it's a trip around the world or pay off your house, whatever you like. Long-term care insurance, that's an insurance product, again, that you need to purchase prior to the event, and it's payable when you're unable to care for yourself. So the current definition is unable to perform two of the important duties of daily living. That's, again, a product that I'm more than happy to talk to you about and give you information on if you wish. It's some folks, some self-employed folks have actually purchased this as a product to enhance their disability insurance, because the only way they wouldn't be working is if they were not able to move. So that's where this comes into play. Again, with Sun Life's product, you don't need to be in a care facility to access it. You can be at home being cared for by a spouse or a family member. It will still pay. No receipts are required. Other plans do. Okay. This session and another session to come will deal more with the will issue. But why is a will important, and why does everybody need one? And it's surprising how many people don't have one. A will can help ensure your personal wishes are followed after you die. Anyone who has assets and or children should have a will. I would go so far as to anyone and everyone should have a will. It's not just if you have assets. You need to be able to leave those that are left behind with the information as to what you want or would like to have done. Certainly that becomes very, very important with children in play, because each spouse has a family. They all want to do the right things by the children, but they need to know what the parents would have wanted. And in this province, we're fairly fortunate in that we can have a hologram will, and a hologram will is a handwritten document that is only signed by you. There is no witness. It has to be dated, so it's basically a letter. You write a letter in your own handwriting, you sign it, and you make the direction to your spouse or whoever is going to be looking after it for you as to what you have happen. Quite often that'll be used in short-term circumstances, like you've forgotten all about it and now you're planning to go somewhere on a plane, and you just need to make sure that if something happens and you don't come back, that things will be looked after. So what is an executor? An executor is the individual that you charge with looking after your wishes, carrying out your wishes as a result of your will. So again, that can be a parent, it can be a spouse, it can be a good friend. It's an important job. I've done it for a couple of relatives in my life, and it's an important job. It's not an easy job, and it's sometimes not a fun job. So you really need to consider who it is that you ask to do that. If you leave things in too much of a mess, the individual that you have as an executor may not retain pleasant memories of you after a while. So you need to make sure that things are looked after well. In this province as well, there is a power of attorney. So when you go to have your wills prepared, normally the lawyer that you're dealing with will prepare your last will and testament. They'll prepare a power of attorney, and they'll prepare a personal directive. And what are all those things, you ask? Well, a power of attorney allows an individual to act on your behalf while you're still alive, and but unable to make financial decisions for yourself. So a power of attorney, they call it a power of attorney for property. In this province, we call it a power of attorney, and then we call it a personal care directive. But for the sake of this, a power of attorney for property will make financial decisions on your behalf. So I've seen it where something as common as a husband and wife have a checking account, but it's not joint, because they've just never got around to changing it. So the checking account is in one spouse's name. All the money has gone into that account, and now something happens to that spouse. They have an incident where they're no longer able to make financial decisions for themselves. So in this kind of weather, it can happen where they fall and hit their head and they lose consciousness for a period of time, or they can have another health issue that would cause that to happen. When they are the owner of that checking account and there is no power of attorney for anyone else, that money gets froze. So now you can't, your spouse or whoever's also accessing that account cannot get cash out of there. That becomes a pretty major deal. As I said, I experienced it once with clients of mine. Fortunately, it worked out. But the worst case scenario is, you could be starved out, have a big chunk of cash in an account and can't get it out. Power of attorney for personal care. Again, in this province, it's called a personal directive, and that allows whoever you put in charge to take care of your healthcare needs. So it does not need to be the same person that does your property. It needs to be someone that's familiar with your wishes and someone that you trust will fulfill your wishes. And if one of them is, you know, not to have any life-saving measures in the event of whatever you call that, then you need to be comfortable that that individual can ensure that your path is taken. We're even going to finish up here a little early. I could have slowed down a little bit, I guess. So these are some of the resources that are available through Lumino. Is a program that Sun Life supports, that supports fitness and lifestyle, mental health, family health, diet and nutrition, virtual home health, and aging and caring. It's a website or an application that is worth exploring. I believe that you can go on and load it on your iPhone, but I certainly know you can search it on the internet. So if you search out Lumino, it's got lots of great resources as to where you go, what you do, you know, some ideas to help you with the aging process or mental health concerns or fitness, whatever it is that's important to you. Some other online tools that, so if you're interested in, you know, knowing what your life expectancy is, you can go on the sunlife.ca website and you can punch your information in. Those are just some of the calculators that are used. So if you feel uncomfortable asking someone that markets critical illness insurance about how it works and what it costs, you can go on there, you can check it out. You can get prices for yourself. Excuse me one moment. Sorry about that. I've been talking too much all day. You can get prices for yourself with no fear of having someone harass you to sell you a product. So today we've discussed the new face of retirement because, again, people are living longer. It looks a whole bunch different than it did 20 years ago. Different retirement options. We've only touched on a few of them. There are lots. I'll add at this point in time that if you, individuals like me, myself included, offer retirement planning sessions. In my case, I don't charge for those. So if you feel that you would like to explore you know, your retirement income sources and see if you've got enough to retire at whatever age you are, that's a service that I can offer you, and it's free of charge and there is no strings attached. It does take some time, and the information that you receive from the work that we do is only as good as the information you give me. So if you want a good comprehensive plan, then we need good comprehensive information. So protecting your retirement savings. So there's solutions such as the health insurance solutions, and then planning beyond, you need your wills and power of attorney. There is also estate protection solutions, which you can use insurance for as well. And if that's something where you're concerned about having the CRA take a bunch of your cash, you know, if you should suffer an early demise or something along those lines, then certainly we can explore those kinds of solutions as well. You can also go on the Sun Life website and there's a life insurance calculator there as well. Okay. So investors with advice, they suggest, apparently statistically accumulate 4 times more assets. It is not a bad thing to seek some counsel or advice, even if you do it all yourself. It's just nice to know that you're on the right track and you're doing the right things, because not everyone can know everything about everything. That's why there's accountants, because they concentrate on the accounting end of things. That's why there's lawyers to concentrate on the estate side of things. And there's people like us that are in the planning industry that will look at a little bit of all of that and then also include your investments. Thank you very much.